Good morning, everybody. Welcome to this ETF Analytics and Treasury One macro update about what's happening in the markets. With us to present it, it's George Glenos and Quinton Burtonshaw and Andre Celia. We will take and answer some questions and just run through the presentation afterwards. So, George, without any further ado, I'm going to hand over to you to just give us a little bit of update what's happening in the markets and worldwide.
Thank you, Vichard, and hello to everybody. Good to be with you again at the start of a new year, a year that promises a lot of exciting developments, both locally and internationally. And I think this morning's presentation is really just aimed at trying to unpack two of the biggest themes that I think are going to impact financial markets this year. The first is of course, the global business cycle and how that's looking, because we keep hearing talk about rate cuts and rate cuts and rate cuts in 2024, and yet nothing has materialized yet. And the kind of data that we've picked up from overseas sources is actually been stronger than many people had anticipated, especially out of the US, which most central banks benchmark against. So that's the one. The other is, of course, South African, is very much a South African-focused theme, and that is about the government finances, the fiscal risks that South Africa faces, and how this ANC government is likely to manage that. So, if I can, I'm just going to jump through some of the slides that I've put together today. It's a slightly shorter presentation than normal. And we'll try and get these done as quickly as possible, but as punchy as possible, so that you can get back to debating some of these topics with Treasury One and ourselves, if you like, or send us some questions if you have any burning questions that you need answered. So the first point is that in this day and age, it's almost quite difficult to start any discussion, economically speaking, without first focusing on what's going on geopolitically. It's been a tumultuous few months. In fact, it's been a tumultuous few years. First, we started with Russia's war in Ukraine. That peaked and settled back down again, and those risks kind of became better understood, and people began to appreciate where these risks can manifest and where not. So we got to grips with that, but just as we were starting to get under some measure of understanding or control on that, suddenly we had the unexpected attack on Israel and Israel's response, and the war on Gaza that followed. Obviously, we've spoken about this once before, and I indicated to you that the geopolitical risks this time around were bigger than that of Russia and Ukraine. That we covered, and we said that this in this example too, we would anticipate that these geopolitical risks would subside unless the problem started to become more regional. And unfortunately, it has become a little more regional. So what we found is that it's spread into the Red Sea attacks. The Red Sea attacks are potentially one of the biggest logistical disruptions since the onset of COVID. In some instances, being described as even more disruptive than the onset of COVID. So these Red Sea attacks are very much now part and parcel of the logistics theme that's impacting the world. And of course, that's got inflation implications. To those Houthi attacks on vessels in the Red Sea, we've had the US and the UK attacking some Iranian-backed military-type installations in the region, and that stretches from Syria into Jordan and elsewhere. So it has become a little bit more, and so you can see the geopolitical risk index has ticked back up again. Thankfully, it looks like it's on the way back down, but so volatile is this number that I don't think that we can guarantee that it will remain that way. Nonetheless, we need to pay attention to this because it does impact logistics. It therefore has some implications for inflation, which naturally impacts the central bank decision-making that takes place through the world. We also know that it potentially impacts the outlook for oil. And if one has a look at the oil market, we know that the put-call ratios are still very much in favor of predicting or hedging against an oil price that could still jump fairly significantly. And quite clearly, the market still anticipates or believes that there is a risk that this could escalate into something a little more serious. But against this backdrop of this higher inflation environment, we do know that the bulk of central banks remain relatively restrictive in their monetary policy. And so here we've got a list of countries that have adjusted interest rates recently. The ones in green are the ones that are deemed to be more restrictive. Unfortunately, my little bubbles have moved, but the South African bubble was supposed to be the fourth from the right, and probably another 7 or 8 slots further to the right of that was the US bubble, just to give you some reflection on how South Africa compares to what we're seeing in the US. So really, there's only a handful of central banks that are not restrictive at the moment. The bulk of the world remains restrictive, and for the time being, they're likely to remain that way. Insofar as the major central banks are concerned, the latest updates are that they will keep interest rates higher for longer, for as long as inflation allows them to keep it. If inflation obviously deteriorated, we would have to debate whether interest rates need to rise again. At this point, inflation looks like it's on a firm downward trajectory. And so investors in the market are now positioning themselves for rate cuts later this year. But the big adjustment that's taken place over the past 3-4 months is that all 3 of these lines, the projected lines, which are the dotted lines that you see there, those are the forecasts. All 3 of those lines have been adjusted upwards. And so now you've got a Fed that is almost bang on in line with what we were seeing from the Bank of England. And that wasn't the case just a few weeks ago, actually. That's been an adjustment that's happened quite dramatically since the latest FOMC decision and statement. The guidance given is that interest rates in America are likely to remain higher for longer. And the reason that they are going to do so is because the US economy is proving amazingly resilient at this point. And so the Fed doesn't feel like it's in any rush or under any pressure to reduce interest rates. The soft landing scenario that they have spoken about in the past still appears to be on the cards for now. And whilst they're not seeing any ugly numbers coming out of the economy, it means that they are likely to keep interest rates more elevated, and they will continue to drain the size of their balance sheet to the extent that they can. So the more they can normalize monetary policy, the more they will push that envelope and try to do so, which, to be honest, over the longer term is probably the right action to take. So I don't have too much criticism for them on that. But the only consideration that I have, and something that I think a lot of people will be debating, is just how far they can push this envelope, because they're walking a tightrope. Leave interest rates at these levels too long, drain too much liquidity out of the market like they're doing through quantitative tightening, and you risk tipping this economy into more recessionary conditions. And then that changes the whole dynamic with regards to interest rates. But central banks are indeed draining liquidity, and we can see that from the size of their balance sheets that have now turned negative. So during COVID, you can see how big that balance sheet swelling became. Since then, we have seen the exact opposite. So that has reversed, and many of these central banks are now draining liquidity out of their economies, and that stands to reason. That draining of liquidity and what we call quantitative tightening on the part of the Fed is highlighted in that pink block. You can see that the blue line, which is the Fed's balance sheet, has shrunk fairly significantly. They have drained about $1.3 trillion out of the US banking system in the past 18 months or so. So that's roughly what they've done. And that blue line is trending very firmly lower. And so long as the US economy holds up, you can appreciate that they will probably shrink that back down to at least 7 trillion, if not less than that. So that is, again, a normalization of monetary policy. One of the side effects of that has been to reduce money supply growth. In fact, money supply is now shrinking, which is something quite extraordinary to see in an economy like America. Granted, it was growing at more than 25% during COVID off a really high base. So that is an explosion of money supply into the system, but they're actively draining that now. The implication of this is that it will place some emphasis on the credit cycle. So we need to be careful about just assuming that US economic growth remains as resilient as it is, when you can see and you know that money supply growth is shrinking and that the credit cycle is going to come under pressure. Corroborating evidence is also very clearly visible in the dollar liquidity cycle. You see that red line moving sharply lower, and it looks like it's, as of the December data, resuming its downward trajectory. So it has further to fall. And so long as interest rates remain as elevated as they are and the central banks are draining liquidity as they are, we expect that dollar liquidity cycle to tighten up further. Again, the implication there is be careful about assuming that this resilience that we are seeing in the US economy is going to persist in the way that it has recently. It's quite possible that this kind of liquidity drainage is going to place quite a lot of pressure on that economy eventually. And ultimately, we anticipate that it could lead to recessionary conditions. We still have... Yes,
can I quickly jump in here? I just want to quickly ask, the New York Community Bank Corp, as obviously part of liquidity and draining of liquidity, they bought some of those failed banks' assets, and they're under pressure at the moment now. Does that all filter through in this liquidity cycle? Part of extra bank failures that's coming in the US, or how does that all fit in?
Yeah, so the bank failures remain a feature of the US banking system. There is still quite a lot of pressure in the system as a result of house prices that are no longer rising as they were. So not only do you have house prices that are not rising to gradually increase the size of the bank balance sheet, but you also have some non-performing loans that are ticking up. So you've got delinquencies that are now starting to rise. And so banks, especially retail banks, have come under some pressure, and that does feature in the dollar liquidity cycle and in all of the liquidity calculations. So the central banks are aware of this. Look, they've got a fine line they've got a very fine line that they've got to just be mindful of. On the one hand, they don't want to interject into the market and distort things just because they're scared of any failure. Failure is actually a necessary part of any well-functioning democratic market, free market driven economy. You need that failure to keep people honest. You need that failure or the risk of failure to ensure that bank and corporate management do their jobs, and so that they know that they're not going to get bailed out at every turn. So I think that that is normal part of business, and I don't think that the Fed will stress about it too much. What they will stress about is if they believe that the level of the stress in the banking system becomes something more systemic. If they believe that it's systemic and could disrupt economic activity fairly significantly through creating another credit crunch, for example, where it just becomes impossible for companies, corporates, households to be able to raise capital because the banks are shutting down, that becomes problematic. And in that instance, I have no doubt that they will step in and try and support liquidity in whatever way they can. It'll probably come in the form of a fresh bout of quantitative easing, as it did in March of last year when they experienced the first bout of bank failures. But right now, it's a lot more orderly. And so long as it remains orderly and these buyouts are taking place, I think it continues. I don't believe that it's systemic at this point. It doesn't look like it to me, nor does it to the Fed. And so I don't think they're going to be ringing alarm bells just yet, but it is something to keep track of, and it is part and parcel of a tightening liquidity environment. Not sure if that answers your question.
No, it's perfect. Thanks.
Yeah. So, just getting back to the theme of the US business cycle, we know that the yield curves are inverted. We know that these are leading indicators of a business cycle that's maturing. So quite clearly, when you see inversions of this nature, it does portend a weak economic growth going forward. Actually, the danger period is when the yield curve starts to steepen again, and that's very much a function of the shorter dated bond yields dropping, and they would drop because the central banks are cutting rates. The central banks will be cutting rates because they see some ugly numbers coming through the data and are now responding to this weaker economic climate that's upon them. So to the extent that they start cutting rates and the yield curve starts to increase, that would be your first warning sign that recessionary conditions are about to hit. We're still inverted. We haven't disinverted. Well, we have disinverted slightly, but we haven't normalized. In other words, got an upward sloping yield curve just yet to speak of. So for now, it doesn't look like there's imminent danger, but I think it is notable that these yield curves have disinverted to some degree. If I have a look at the US Fed's own recession probabilities data, it's quite interesting to see that as of the December and January data, that some of these indicators have now signaled that there is a much higher probability of recessionary conditions. Interestingly, this happened post the latest FOMC decision and statement. So in signaling that the Fed was going to keep interest rates higher for longer, interestingly precipitated into a rise in recession probability. So that gives you a sense of the fine line these central banks are walking. On the one hand, they want to try and normalize monetary policy as much as possible, but they do risk tilting the global economy into recession if they allow it to go for too long, and if they keep those interest rates too high. So where are we? Well, at the moment, we've still got unemployment in America that remains quite benign. We're still sitting at a roughly 3.5, 3.7, somewhere around there. It's not a concern at this point. Interest rates are well elevated. They're about the highest levels that we've seen in 20 odd years. So it has been a significant move by the Fed, and so we do anticipate that unemployment will eventually respond. But quite clearly, the dam wall hasn't broken on that front yet. We do hear of some corporates that are looking at retrenchment of staff and reducing human capital, but they haven't done so en masse just yet. So we're still waiting for that penny to drop. Equally, when we have a look at the US GDP nowcast, it remains elevated. I mean, growth of 2.5% is actually quite impressive at this stage of the business cycle. One would have anticipated that it would be a lot softer than this. And yet, we've had some fairly significant and resilient growth numbers coming out of America. Now, a lot of people will be asking, but how is that possible? You're showing us a whole bunch of indicators that are telling us one thing, that this business cycle is waning and that it's under pressure. And then you show us a GDP number, which remains pretty strong. Well, the answer to that, and before I get there, the answer to that is really it's multifaceted. But it is fair to say that much of the information that we're seeing at the moment is also what's keeping the dollar afloat. So the dollar appears to have peaked and maybe is showing signs of wanting to head lower, but it hasn't done so just yet. It's still at very expensive levels. Part of the reason is because there's still a lot of funding that is flowing towards America, and we'll touch on that in a bit. But the dollar, just for today's purposes, remains very expensive, and we always need to keep that in the back of our mind because at some point it's going to correct. The question is, what's going to be the catalyst for that correction? Is it about the fact that the Fed is going to cut, or is it about the possibility that the Fed could cut more than other central banks? Now, at this stage of the game, the market is unsure, which is why the dollar remains elevated as it is. It may have peaked, but it's remaining elevated. And part of that is because, well, other jurisdictions around the world are actually doing worse than America. And so America might still enjoy some of its, what they call US exceptionalism, for a little bit longer.
George, just before you continue, benign unemployment in America, fairly robust growth in terms of interest rates and where the economy, and et cetera, I agree. But question, we've had the war in Ukraine and Russia for several months now, more than a year. We've got the one in Gaza from the Israelis and Hamas, and several other attacks. How much does the military in the United States and the growth there and manufacturing there and sales of arms, etc., throughout the world contribute to this relatively benign unemployment and growth in the US economy?
Yeah, thanks for that, Andre, because it's right on cue. So the next two slides were just to discuss, what's keeping this US economy afloat to the extent that it is. One of the reasons is this excess savings that got generated during COVID by the government. So this is where the government quite literally used its own balance sheet to write checks out to households and businesses to keep them afloat. It created a buffer of about $2.25 trillion. That buffer has been drawn down, and now we're under $1 trillion, but we still got a good 900 billion to still work through. So this consumptive element in the US economy is to some degree being driven by this excess savings. We also know that the government has been running a big budget deficit, and this is more to your point, Andre, because in the right-hand column over here, where I've written a couple of extra points, it's not just that the government is just saving and spending very aggressively in the economy and running budget deficits north of 5% of GDP and heading towards, by the Congressional Budget Office's own forecast, towards 7 and 7.5% of GDP. So government's still spending very, very aggressively, but they are also funding some of these war efforts that you've spoken about. And so we do believe that people need to recalibrate how they think of these war efforts. People think about them in terms of aid to Ukraine and aid to Israel. Actually, what they are is support for the US military sector. So they're not sending that money to Ukraine. What they are doing is sending military and machinery to these places, and that is being manufactured in America. So you have got a big boost, not just to military as it stands, but you've also got a boost to manufacturing too. One can only suspect or believe that the economic growth dynamism that we're seeing in the US would be a lot softer than it is right now without these two consecutive wars. So you had one after the other, and in both cases, they've dragged on for a lot longer than people had anticipated. So we do think that there is an element to the resilience of the US economy that is attributable to these war efforts. So I think you're quite right to raise that. And it is something to keep a very close watch on, because I haven't seen any indications that the war in Ukraine is about to end anytime soon. And insofar as Israel is concerned, well, there's a lot of pressure mounting on ceasefires, and South Africa's taking Israel to court for genocide, and all of that just ups the ante and raises the pressure on Israel. But they haven't slowed down their war efforts. They're continuing. And I was listening to one of the news vendors last night, and they were saying that at this stage, the Israelis believe that they have caught 17 out of the 24 military sects that operate within Gaza. So they're sort of 2/3 of the way through their operations. So you would imagine that there's probably still another month or two in this left that's going to continue. And so there's still more stimulation that's being applied to the military sector, and by extension, manufacturing as well in America. And so I think that's a valid question, and I think there's decent enough proof that is indeed impacting on economic dynamism. The ultimate consequence of all of this is whether it's the excess savings, whether it's the government spending, whether it's the war efforts. What is happening is that the US economy remains more buoyant. And as it remains more buoyant and producing stronger growth, and earnings are still coming through, on top of which you've got higher interest rates compared to other DM markets, you still have a lot of foreign flows that are being attracted to America. And so the dollar is enjoying that support while it lasts. So for now, there is a bit of a virtuous cycle that's being created. Why? Well, because these flows are heading towards America. America is able to sustain a higher level of growth than the rest of the world. They're equally allowed to sustain higher levels of interest rates compared to the rest of the world. So they attract more capital. The capital keeps the dollar strong. The strong dollar helps keep inflation under check. And so they have this almost Goldilocks environment at the moment that's being perpetuated by all of what we've just discussed. So the big question now is, how much longer does this Goldilocks scenario for how much longer does it exist? You know what some of the drivers are that are creating it. How long do they exist? Do they exist for another 6 months? Do they exist for 9 months? Is it another year? At this stage of the game, it looks as though the approximate timing, and that's just working on further drainage of the excess drainage of the excess savings that they've got, regime change potentially with Donald Trump coming in and tightening up the fiscal reins. All of that could have a material impact on the US in the second half of this year. And so we penciled in the second half as the really interesting part of 2024, because that's when a lot of these cycles and a lot of these changes may take place. He's already indicated that he wants to stop the war in Ukraine. He has indicated that he wants a solution to Israel. He has said that he is going to look at cutting back on expenditure of government. All of these are factors that has kept the US economy going at the pace that it's going. If he steps in and does implement many of these changes, that is going to have an effect. And so, again, second half of this year, I think is going to be a really interesting one to see how that all unfolds. So, just drawing this back to South Africa now, you can see how the rest of the world continues to grow pace, largely driven by a very buoyant US economy that continues to power ahead. South Africa, unfortunately, we're still stuck in our much flatter trajectory, and it's the same old story of serial underperformance of state-owned enterprises. The grey listing that happened last year, not earlier this year, but last year, South Africa no longer being investment grade, international relations souring, rampant growth, all the stuff that we know is impacting at the moment. And so we have to get used to the idea that we are just going to struggle along at least until we have some material regime change. And we know that something has to happen because there is a budget storm brewing. And we know that from the latest budget deficit numbers that are now sitting at around 6% of GDP, they've deteriorated. We were told in the medium-term budget that the budget deficit would come in around 4.9. Well, that doesn't look like it's going to be accurate. In fact, we think it's currently probably closer to 6%, which has naturally driven the debt to GDP ratio much, much higher. So we're now talking about figures of around 72% currently. And that's unlikely to improve in the short term, especially with interest payments on debt steadily rising to levels that are deemed uncomfortably high. So we've got levels back at around 35% of expenditure, and that is unfortunate for an economy that needs to spread that budget as far and wide as possible. So the net result is that we have found many of South Africa's assets being structurally discounted. One of the best ways that we can see this is by looking at the bond market and seeing what sort of spread the yield to maturity has over the coupon rate. And there was a point in time when the yield to maturity was well below your coupon rates. That was during the golden period when we had fiscal consolidation, ratings upgrades. That was the Trevor Manuel time and Thabo Mbeki. Then you had, a steady deterioration that began after that. At first, it wasn't particularly disastrous because we could understand and followed the financial crisis. A lot of countries were stimulating and supporting their economies. But it was after that things started to deteriorate. It was in the latter part of the Zuma administration that things really started to get bad. And roll forward to the Ramaphosa era, and quite simply he hasn't been able to change the trajectory. So entrenched are the patronage and corruption lines within the ANC-led government that it has just gone from bad to worse. And now we're sitting with the unenviable position of sitting at the top of the list of these countries in terms of the spread of our yield to maturity over the coupon. The coupon essentially is kind of like the yield that these bonds were first launched at. So, that gives you a sense of just the kind of premium that's being applied to South African to South African bonds, and you're talking about interest there that's being paid that's as much as 250 to 300 basis points higher than it would ordinarily need to be, which is a substantial amount. I mean, one can only wonder and speculate how much stronger the South African economy would be if it wasn't for that kind of higher interest rate environment. So the net result is that...
George, sorry, could I just ask a quick question? Given the fact that we obviously have such a yield premium baked in, and I'm not going to try and take the shine away from our presentation, which is coming later on in the month around the budget, etc. Do you reckon that premium remains entrenched given the risks that we're currently facing of Eskom's debt having to roll up onto the government balance sheet, all of those various components having to be sorted out? I mean, all of these things that you've told us really point to a sustained period of structural weakness, which then runs into the elections. Even if we get a very favorable outcome on there, what do you think the timelines are to start fixing this stuff?
Yeah, so, I'm thinking about this practically, Quinn. I just can't see the ANC government implementing hard-hitting reforms at this stage of the game that might detract from an already weak voter base. So I think that they probably just continue as they go. I suspect that they are going to be forced into bailing out Transnet. That's a further 130 odd billion on top of everything else. So your debt to GDP is going to jump by another few percent just because of that. The rolling up of Eskom's balance sheet is ongoing, but make no mistake, it's not just those two SOEs. If you have a look at the unfunded liabilities that sit off balance sheet that no one really knows of, in total, including Eskom and Transnet, you're probably talking about a full R1 trillion worth of unfunded liabilities that would be to bail out things like the municipalities, like to catch up on infrastructure that is now broken, roads that are falling to pieces, railway networks that need desperate maintenance, hospitals that are under-resourced now, the road accident fund that needs a bailout of its own, malpractice suits that have piled up to many hundreds of billions. If you have a look at all of these together, you're talking about at least 1.2, 1.3 trillion rands worth of unfunded liability. So the situation doesn't get better at this stage of the game unless we implement some very, very deep and hard-hitting reforms. The situation just continues to deteriorate. So I'm not particularly hopeful for a significant improvement in 2024. What might happen is once these elections are out of the way, and whether it's the ANC that comes in for another 5-year term or the coalition government that is formed thereafter, it's after that, once the power struggles die down and settle down, that we can start having pragmatic discussions about what needs to be done. And about the only solution that I can see for South Africa at this point is a heavy, heavy dose of privatization. That's about the only kind of reform that I see right now that has any chance of working. Anything less than that, I think we just continue down the same grinding deindustrialization path that we're on at the moment. So it's not a particularly pretty picture, which is why, if I get back to this chart, why the Rand continues to trade at a discount, and it has been trading at a discount, just like bonds have been trading at a discount and have been doing so for quite some time. And it's very neatly reflected in our business cycle indicators that place South Africa in an adverse condition. That's the situation that we've got on both the top half and the bottom half of this chart. It's telling us that South Africa is in a desperate position. Growth is way below what they anticipated it to be. The constraints on growth just seem to be growing with each passing day, with infrastructure creaking, with Eskom falling over, and struggling to rectify itself, with Transnet falling over, with the ports not able to process exports. South Africa is under tremendous strain right now. So unfortunately, these things combined tend to keep our inflation rate more elevated than it would otherwise need to. Thankfully, we're back within the target range, but that's come at a tremendous cost of growth. Our interest rates would not need to be as high as they are right now If it wasn't for the fact that all of these administrative failures on the part of government have imposed tremendous cost on the economy, and whether that be logistics, whether that be the price of electricity, the increase in rates and taxes because municipalities are going bankrupt, or whether it be Transnet that needs to get bailed out and will probably raise the cost of rail transport at PRASA level, as well as through corporate mineral transportation to the ports, or the throughput at the ports. All of it combined just adds to inflation. And so that elevated level of repo is likely to remain that way at least until US rates start to come down and ease the pressure on the domestic market. But for now, it seems like we need to get used to the idea of a very constrained economic growth environment going forward. And it's not because our commodity terms of trade have deteriorated. Yes, they've deteriorated. Certainly since the beginning of the year, they've dropped from around an index level of 23.5 down to 21. That's roughly a 10% odd move, an 8-9% odd move. So it's not insignificant, but that's not the reason why South Africa is underperforming as it is. It's underperforming for much more structural reasons. And so, we constantly find ourselves batting in terms of currency performance in the lower end of the chart on the right. And we seem to remain there, and we have remained there for quite a while. And it's also not because of our trade account. Our trade account remains in surplus. Our current account is almost neutral. So it's not as a result of the underlying economy that things are as bad as it is. It's because foreign investors and domestic investors are trading like South Africa is in deep trouble and it necessitates that South Africa needs to trade at a discount. If it doesn't trade at a discount, people are not interested in exposing their money to this place. And so if you have a look at these valuation charts, I mean, the outright valuation is interesting. Okay, so against the dollar, for example, you're talking about a 12% undervaluation on a real effective exchange rate basis. Nominally speaking, you're talking about 7% undervalued. To me, that's not the important thing. Just have a look at the chart on the left and notice that we've been sitting at these minus 12, minus 13, minus 15, sometimes even more percent undervaluation levels for now the better part of 2 years. That's the important thing. If you look historically back at the beginning of 2020, and you look before that at Nenegate at the end of 2015, beginning of 2016, when we spiked down to these levels, we bounced back pretty quickly because it set in motion a whole series of events that rebalanced some of the flow dynamics in the South African economy. That's not the case this time around. This time around, we've gone down to these levels, and you would think that they'd be unsustainable at these levels, but they haven't been. We've remained undervalued for the better part of 2 years now. And it doesn't change. When you look at the picture versus the euro, it's a similar picture, although even worse, because there we've actually lost ground to the euro. And against the pound, again, similar sort of context. So unfortunately, we are sitting with a position where inflation might be declining, and by all indications, it looks like it's set to drop a little bit further. But you can see on the chart on the right how our inflation, South Africa's inflation, is now, well, we were below the US at one point, back through the middle of 2022. It's no longer the case. Our inflation has remained structurally higher. America's inflation is starting to come down, and that red line is probably going to nudge lower through the course of the next few months. South Africa's blue inflation line is probably going to follow, but at a slower trajectory. Again, just reinforces the point that interest rates and the repo in South Africa still needs to remain a little elevated. So we didn't buy into the idea of a March rate cut. Even May was starting to push the limits. We think more likely is going to be the middle of the year, beginning of Q3 is probably your most likely rate cut scenario in South Africa. We think that's probably prudent on the part of the central bank. So, ultimately, where does that leave us for the rand? Well, it remains in this zone, which offers a lot of value to exporters at these sorts of levels. If you have to take out forward cover, and in this particular instance, we used the 12-month outlook, there is a high probability that your forward rate is going to beat spot a year from now, just because of the extended level of rand undervaluation. So that's what it's telling us. It's telling us that fair value is still below 18. But that's not useful when you can quite clearly see that we have remained at these very elevated levels of undervaluation in the rand for well over a year now. And it could remain that way. So this is the unfortunate scenario that South Africa is faced with right now. It's very much a case of needing to just appreciate and accept that so long as this government does not implement significant reforms, that we may remain at these distended levels for a lot longer than we anticipated. And even though the rand is undervalued and at some point will likely recover to some extent, it might require the dollar to weaken for that to happen, rather than the rand to strengthen on the back of some strong domestic reforms that are implemented. And on that note, Richard, I'll bring an end to this and keep it open for more questions if you have any.
Yeah, George, I'm just going to go back to the previous graph quickly. Andre, we've discussed this previously about the rand being happy between this 1820 and 1920 range. And George also mentioned it just now, inflation differentials in South Africa still running higher than that of the US. And you can see from this graph as well, the adjusted fair value ticking up quite, So just to reiterate to what you said about a week or two ago in one of our other presentations about if the rand stays here, that we will catch up to fair value actually quite quicker than we anticipate.
Yes. If our inflation rate is higher than the rest of the world, then the rand should, than America, then the rand must devalue. Not devalue, it must weaken to just counter that inflation rate differential. So if the rand stays here for a 2-year period, then it will catch up in the sense that it will be less undervalued, simply because of inflation rate differentials. But that's not my concern. I think that the rand could very well recover. I agree with George. Second half of the year could spell some trouble for the US dollar. That trouble for the US dollar could spell some positiveness for euro and pound, etc. That could help the rand to strengthen slightly against the US dollar, which means that this undervaluation would correct. However, on a trade-weighted basis, I don't think that the rand will recover, because I think the rand will lose value against the euro as the euro gain traction, as the pound gain traction, etc., and all the other currencies. So on a trade-weighted basis, I think that the rand could actually go further undervalued, simply because of all these structural problems in South Africa, politics that doesn't seem to be gelling out very well for us either, stalemate from government, they're not making decisions in the first half of this year in any case, and in the second half, battling with coalition governments not going anywhere. So I think we have a problem, and I think that problem is going to keep us undervalued on a trade-weighted basis, purely against the US dollar. It could look different. So this could look different against the US dollar, but as I say, trade-weighted basis, I'm not so positive about the rand in the country at the moment.
Yourself, George, want to weigh in any last comments before we end it off?
No, I think Andre summed it up quite nicely there. I think that if we do get a bout of rand strength, it's at this stage of the game, unless we, like I said, the caveat to this view is that Ramaphosa surprises us in the budget, and they announce that they are pressing very hard on the privatization front. If they do that, you have to turn a little more optimistic on South Africa's chances over the next 5 to 10 years. If they don't do that, if that's not forthcoming, then I think it's more of the same. And I don't see a particularly brilliant reason for rand to strengthen a lot further. We've got a lot to fix and sort out in this country, and right now some of the situations almost look like they're too far gone for any meaningful reforms to be implemented. In some cases, these municipalities are so broken that it would almost be better to start them from scratch than it would be to fix what's already there. It's that bad in some cases. So there's just an awful lot of money. I mean, I've seen some forecasts on what it would take for South Africa to catch up on its infrastructural backlog. In other words, what needs to be built, what needs to be replaced, what needs to be maintained. And that figure sits at close to 3 trillion rand, just to give you an idea. I mean, that is just, that's almost like rebuilding a small economy. And it's staggering that we've let it get to this point, but it's caught up to us, or it's caught up to this government. And there's nowhere to hide anymore. They can't escape it because it's everywhere. And so they've got a choice. They can try and fight for the last remaining remnants of support by not taking unpopular decisions now. But I think all they're doing, that just amounts to a stay of execution for the ANC. At this stage of the game, I think you've almost at a point of got nothing to lose. It's better to come up with something like some significant reforms and at least be able to go into an election boasting that you're taking some very robust and aggressive action to address some of the problems, rather than trying to paper over them, saying, politically trying to massage a message to say that you are going to fix this by just doing things a little bit better. I don't think that washes anymore. I think that the government has lost credibility, and so rand still has to trade at a discount, just like bonds do, just like equities do. They're all undervalued relative to historical valuation methods and metrics. So that's the story of South Africa. South Africa is on sale, but it's on sale because the quality of the product is poor. And that's the only way we get to sell it. And until such time as we improve the quality of the product and get South Africa's fiscal performance right-sized and looking good again, I'm afraid I cannot turn overly optimistic on the rand whilst we're facing these kinds of difficulties. So for now, I'm very much in Andre's movie. If we get a recovery, I think it's not a particularly powerful recovery. It's possible, but it's not a particularly powerful one. What we could have is just a rand that remains undervalued for a while, and that we eventually just catch up to the inflation differentials to get ourselves close to fair value. But that's going to be at these higher rand levels.
Thank you so much for your insights again. Thanks, Quentin. Thanks, Andre. Thanks, George. We will see everybody on the 22nd of February at 8:30 in the morning of our live stream, hosting about what's happening in the budget. George has touched on some of the aspects. He will be looking about other elections worldwide that's coming up out of the US, particularly, that we'll wait to verbite the breath. So we look forward to hosting you again on the 22nd of February. For now, have a wonderful day. Cheers, everybody.
Thank you. Cheers. Have a great day.